Hey everyone, it's Mike Adams here with The Simple Dollar. And have you ever wondered, what exactly is a line of credit? And more importantly, if you've been looking into that, you may be wondering, how does a line of credit actually work? We're going to talk about that and we're going to break it down in today's training. And just for the record, we do have a full-on article about this on our website over at thesimpledollar.com, where we break this down in detail, because here at The Simple Dollar, we believe that personal finance doesn't have to be complicated, and we are here to help. So make sure to visit us over at thesimpledollar.com, and as well, I'll put the fully detailed article link in the description of this video here so you can check that out later. So on to today's video, where we're going to be breaking down what is a line of credit? And of course, how do you use it? How do you use a line of credit? And so to define the term, what is a line of credit? A line of credit is essentially a borrowing option that's available at most banks. Most people are familiar with loans, which is where you get a fixed dollar amount. Let's say you're gonna get a mortgage to buy a house. You're gonna get a fixed lump sum all at once, okay, in a loan, and you're gonna repay that back to the bank with fixed payments over time. Okay, and that's typically how it works with a loan. The great thing about a line of credit is that you don't have to take a lump sum all at once. So with a line of credit, they're going to give you a credit limit. And that allows you to utilize your line of credit to make purchases for whatever you see fit. And you don't have to take it all in a lump sum. The issue with taking it all as a lump sum is that you have to start paying interest on that right away. And one of the beauties of a line of credit is that if you don't use it and there's no balance on there, you're not using any of your available credit, there will be no interest charged to that line, again, unless you're carrying a balance from month to month. So it's a very flexible and convenient option for you to be able to draw money, okay, or be able to leverage credit when you need to. So how does a line of credit work? Well, again, we touched on that a little bit already. You see, lines of credit work a little bit like credit cards do, okay? And essentially, a credit card is a type of a line of credit. There's a multitude of different types of lines of credit, and depending on your particular situation, there's gonna be different types of lines of credit that are gonna best suit your needs. And don't worry, you don't have to guess, you don't have to figure it out right here, right now. Check out the article that we have on thesimpledollar.com, where we really break this down, and we break down all the different types of lines of credit that are actually available. Again, if you're a business owner, if you own a property, there's all types of different types of lines of credit that will become available to you depending on your particular situation. And whichever one is the best fit in the moment for you is probably the one you're going to want to get. So bottom line is, make sure you check out the article later over on thesimpledollar.com to get the full breakdown on all the different types of lines of credit that are available. And one of the great things about a line of credit is that it's actually revolving. So you can draw money out of the line of credit by using it. Let's say, again, you're using a credit card and you swipe that line of credit to charge groceries or whatnot. That balance is going to go onto your line of credit, and it's going to go against that available balance, okay? And as long as you have an available balance available, you'll be able to use that card. And the great news is that obviously when you send in your payments on that credit card, it creates new available credit in the line. So you can draw money out of the line of credit, and then when you make your payments, you can put money back into the line of credit to then reuse the line of credit again in the future. So that's one of the big differences between a loan and a line of credit. A loan is a one-way lending instrument, where again, you get that lump sum and you're gonna make fixed payments to the bank every single month for the duration. But when you make those payments, you cannot take your loan to the grocery store and swipe it to buy groceries for your family. Loans don't work like that. Lines of credit do, because again, they are revolving. You can take money out of a line of credit, and then you can put money back into the line of credit. Now again, there's many types of lines of credit that are available and out there depending on your situation, but all the different types of lines of credit usually come in two forms. One of them is a secured line of credit, and the other is unsecured line of credit. So the difference there, okay, a secured line of credit means collateral, okay? So for an example, with a home equity line of credit, this is where you're able to get a revolving line of credit, but it is secured by the equity in your property. So again, you must own a home and you must have equity in that property to secure the line against. And what that means, of course, is that if you default on that line, the lender can then go after the equity in your property. So again, it is a secured, collateralized debt obligation. So again, when you think secured line, just know that there's going to be some collateral to get a secured line. Whereas with an unsecured line of credit, and typically these are going to be personal lines of credit from the bank. It could be a credit card as well, where you literally just have to fill out the application. They grant you an available credit limit with no collateral. You don't have to put your home equity on the line. You don't have to put a vehicle on the line to back up the loan, okay, or back it up with your savings or money in your savings account. An unsecured line of credit has no collateral, which is fantastic. So how do you get one of these lines of credit? Well, simply put, it's as simple as filling out the application. And the great news is here at thesimpledollar.com, we've actually done a ton of due diligence on all the different types of lines of credit that are out there. And we've dug into a lot of these lenders and companies to find the best rates and the best terms for our subscribers and our readers. Make sure you go and check out the research we did over on thesimpledollar.com, which will help you kind of dial in, which companies are offering the best rates. But simply put, to get a line of credit, you simply have to fill out the application. Now, do we recommend that you just run out there and start filling out applications for lines of credit? No, definitely don't do that. Before you apply for any credit whatsoever, there's a couple of things you're gonna wanna do first, just to make sure, in essence, you're not barking up the wrong tree. Sometimes people will get into trouble when it comes to applying for lines of credit because they don't actually have the credit, or shall I say the credit score required to get that particular lending product. So if your credit's already in really bad shape, yes, there are some lines of credit that may be available to you, but many times they're gonna come with a higher interest rate, potentially with fees on transactions, potentially as well annual fees that you have to pay simply for opening the line. So before you actually go out there and apply for credit, it's best to know your credit and be very familiar with where you stand credit-wise before you apply for something that you're not going to qualify for. Because if that's the case, you're still going to get a hard inquiry on your credit report, which if you have a lot of those inquiries, it will actually lower your credit score. And on this application, lenders, when they're assessing your credit worthiness, they're going to look at your income, your job, where you live, and also they're going to dig into any other factors that may prevent you from making payments on this potential new obligation, and really any other factor that will affect your willingness or your ability to repay this financial obligation. Now, if you are in fact wanting to get a home equity line of credit, or even a business line of credit, okay, that's done under your company's EIN number, you're gonna need some additional financial paperwork and documentation to verify your income. With those types of lines of credit, there will be more paperwork involved versus an unsecured credit card or something like that. Usually those will just be done with a simple form online. Now, one of the most important factors to consider when opening a new line of credit is the terms of that line of credit, and specifically the APR, or the annual percentage rate. Okay, this is the interest rate that they're gonna be charging you on any balance that you carry from month to month. And the goal is, of course, to get the lowest possible interest rate on your line of credit. The bottom line is when you carry a balance from one month to the next, yes, there's gonna be some interest charged, but the bottom line is we would like that interest to be as little as possible, making it still easy for you to pay down your debt. When the interest rates are very high and they're adding quite a bit of interest to your account every single month, it can make that bill quite a bit more daunting and quite a bit more difficult to pay off, and you'll end up paying much more in interest over the time of paying down that balance. So definitely pay attention to the interest rates on your line of credit. And secondly, before you apply, make sure that you have checked out multiple offers. Sometimes folks will go to the very first bank and the bank will say, we'll give you these terms right here. And people are excited to get their line of credit and they're just like, bang, give me that line of credit, and they sign on the line right there without actually shopping around a little bit. Different banks offer different terms, and you could have, let's say, a 740 credit score, and Bank A will give you a line of credit with a 9.99% interest rate, but with that same 740 credit score, Bank B might give you the same size line of credit as far as available credit, but yet they'll give you a 7.99% interest rate. And in which case, unless there's any other fees or anything else in the way of you, making this decision, it would make more sense to go with the line that's going to give you the best terms or the lowest interest rate. So make sure that we don't just get too excited and apply for the very first thing we see. shop it around, make sure that you found the right line of credit with the right terms for you, and from there you can go ahead and fulfill on that application. And again, we've done a ton of due diligence on this over on thesimpledollar.com, and I'd encourage you to check out that website. We have an entire section on lines of credit and credit cards with a ton of training, a ton of education. Again, we believe that personal finance doesn't need to be complicated, and we are definitely here to help. So hopefully you guys found value in this training and in this discussion. If you did, make sure to give this video a like and give it a comment below. And make sure to subscribe to this YouTube channel. If you're on the journey of personal finance and you're moving towards financial freedom, we are here to help. We are going to be putting out all types of different content around financial literacy, personal finance, insurance, banking, credit cards, the whole works. So make sure to subscribe to this YouTube channel and click the bell as well, so that way you get notified on any and all of our future content and updates. But that's all for this video. We will see you in the next training.